Instantaneous fair value gap mitigation, a concept that might sound complicated but could revolutionize your trading strategy. Ever wonder how to tap into the hidden mechanics of the market and ride the waves created by institutional players? Stick around. In today's video, I'm introducing a groundbreaking indicator that leverages instantaneous fair value gap mitigations for incredibly profitable trades. We're diving deep into a tool that can take your trading game to the next level, so buckle up. This is one video you don't want to miss.
Wait for it. Here it comes. Almost there.
To get started with this strategy, we'll add an indicator called FVG Instantaneous Mitigation Signals. Head over to TradingView. That's the platform I'll use for this demo. If you haven't signed up, there's a link in the description below. Once you're on TradingView, load up any trading security on any time frame you prefer, then open the Indicators tab and type in FVG Instantaneous Mitigation Signals. Be sure to select the one created by Luxalgo. So what exactly is an instantaneous fair value gap mitigation? Let's break it down. A fair value gap, FVG, happens when there's a disparity between supply and demand, often caused by sudden price movement that leaves a gap in the market. These gaps show areas where not all orders were filled, creating inefficiencies. Mitigation is when the price returns to these gaps to fill them, balancing supply and demand. And here's where it gets exciting. An instantaneous mitigation fills the gap immediately, specifically 1 bar after it forms. This rapid correction signals a market highly sensitive to imbalances and eager to correct them. It can indicate a potential reversal or continuation in the opposite direction of the original gap's bias. Now let's talk about the key components of this indicator. There's a green horizontal level that marks a bullish FVG instantaneous mitigation signal. At the center, a line called the bullish average level shows the average price of this FVG area. A small green upward arrow marks the candle that mitigated this FVG, and a trailing stop line appears below to manage long positions. This line moves up as the price rises. For bearish setups, the components are reversed. A red level signals a bearish FVG instantaneous mitigation. A bearish average level marks the midpoint of the bearish FVG. A red downward arrow shows the candle that mitigated the gap, and a red ribbon below the chart acts as the trailing stop loss. There's also a hidden feature in the settings for take profit TP and stop loss SL areas. These resemble TradingView's long and short position tools, which can help gauge trade progress. However, I'll disable them since I won't need them. While we're still in the settings, I'll increase the FVG width filter from 0 to 0.1. Then I'll go to the Style tab and disable the bar color and trailing stop options before clicking OK. Now, how does this indicator work? It prints bullish and bearish instantaneously mitigated fair value gaps. Let's start with a bullish one. First, find a bearish fair value gap. A downward price move that creates a gap between candles. Draw the gap from the previous candle's low to the next candle's high. If the very next candle closes above this level, the bearish FVG becomes a bullish instantaneously mitigated FVG. The market corrects the imbalance quickly, signaling strong bullish momentum. Or a bearish instantaneously mitigated FVG, it's the opposite. Identify a bullish FVG. Created by a sharp upward move, draw the gap from the high of the previous candle to the low of the next. If the next candle closes below this level, the bullish FVG becomes a bearish instantaneously mitigated FVG, suggesting bearish momentum. The idea behind this indicator is simple. When a bearish FVG gets mitigated quickly, it's a sign that price may head up. Conversely, when a bullish FVG gets mitigated immediately, it signals potential downward movement. Welcome aboard our crypto arc where dreams meet freedom. Join us on this journey as we empower crypto believers with knowledge and tools to achieve their goals. And guess what? We're just getting started in this world of endless possibilities. Click the link below to join us now. Enjoy 0 fees on spot trading for the first 30 days and a chance to win up to 30,000 USDT in deposit rewards. Join Bybit today and ride the wave of crypto success. Before we move on to trading rules, we need a trend identification tool. Let's add one of my favorite EMA indicators, 7EMA_5MA by Storewise. After adding it, adjust the settings. On the Inputs tab, set EMA1 length to 8, EMA 2 to 13, EMA 3 to 21, and EMA 4 to 34. On the Style tab, disable all EMAs except the first 4. Then click OK. These EMAs help identify trends based on their alignment and price positioning. If the price trades consistently above them in order, it's a bullish trend, we'll only look for long trades. Well, if they're aligned with the price below them, it's a bearish trend, we'll focus on short trades. Now let's break down how to trade with this indicator. For a long trade, 1. Confirm the trend is bullish with the EMAs aligned and the price trading above them. 2. Identify a bullish FVG mitigated signal, marked by a green horizontal level and an upward arrow. 3. Mark the average level, the center line of the FVG. 4. Wait for a price retest of the center line. There must be at least one candle between the signal and the retest that doesn't touch the center line. 5. When the price touches the center line with a wick, if it's a red candle, wait for a green one to print. No candle should close below the center line. If one does, the entry is invalid. 6. Once a green candle prints without closing below the center line, enter a long trade. 7. Set the stop loss below the recent swing low and take profit at 1.5 times your risk. For a short trade, flip the rules. 1. Confirm a bearish trend with the EMAs aligned and price below them. 2. Spot a bearish FVG mitigated signal with a red level and downward arrow. 3. Mark the average level. 4. Wait for a retest with at least one candle between the signal and retest that doesn't touch the center line. 5. When price touches the center line with a wick, if it's a green candle, wait for a red one. 2. Say no candle should close above the center line. If one does, the entry is invalid. 6. Once a red candle prints without closing above the center line, enter a short trade. 7. Place the stop loss above the recent swing high and take profit at 1.5 times your risk. That's the FVG Instantaneous Mitigation Signals Indicator by LuxAlgo. Check it out on TradingView and share your experience in the comments. If you got value from this video, hit the like button and subscribe for more. Thanks for watching. See you next time.